Okay, we are now on air. So Dan, thank you so much for joining me today. I'm really looking forward to this. I think you were one of the first people I heard from when I was starting fundraising for my own company. So this is really exciting to, years later, be able to come back to this. You've become an incredibly active angel investor since. You've gone on to start more companies. But I won't take away your thunder. I'd love to hear from you. Tell us a little bit about yourself, how you got into this whole entrepreneurial world, and what you're up to today.
Well, first off, Catherine, thank you so much for having me. One of my favorite things to do in the world is to talk to other entrepreneurs and investors. And, I feel super blessed for kind of some of the things you mentioned, having accomplished over the years. And it's funny because I look back and, I've been doing this now for 19 years and I feel old. I'm 36 now. So I started when I was young.
Yeah, when you look at the numbers, it's like,
yeah,
oh my God.
it's going to be 20 years next year. So it's crazy. But yeah, no, my story, for those that don't know about it, I had a really tough childhood growing up. So I call it a colorful childhood, getting a lot of trouble. Ended up in jail a couple times by the time I was 17. And it was in rehab that I actually discovered a book on programming. And then, I got out of there, rebuilt the relationship with my family, and finally graduated high school with honors and really just turned my life around. But it was through that process that I just fell in love with computing and discovered the internet when I got out, and that turned out to be kind of a big deal. And then started companies. So at 17, I started a vacation rental site, which sounds like, wow, that should have been a huge success, but was a complete failure because I called it maritimevacation.ca, so Eastern Canada. So total market size of 200 cottages. Then I did a hosting company because I thought that was a good idea. My only feedback to anybody thinking of doing that is if you want any life whatsoever, don't start a 24/7 server.
Right.
I mean, that was nuts. So lost about 20 grand on that adventure. Or as I like to call, life lesson. And then it was, a few years later, I started a company called Spheric Technologies, was an enterprise consulting company focused on portal software back in the day of custom homepages. And that company grew to 30 employees in a 4-year period and got acquired in early 2008. So that was really when I figured out the business side, making money side, and really started cutting my teeth on the angel investing side. So when I was 26, I made my first investment and have since made about 34 investments so far. So about 10 years now. And after that experience, built that in Eastern Canada, moved to the Valley. I think we must have met right around, was I working on Flowtown then when we met?
Yeah, you had just raised 1.5, I think.
Yeah, so did Flowtown, which was a social marketing application. So we took email and social media data and put that together, raised money, ended up selling that 3 years later. Then started a company all in San Francisco, then started clarity.fm. So a lot of people may have heard of that or used that. It's a platform or a marketplace for entrepreneurs to get advice from other entrepreneurs over the phone. I know you've done a bunch of calls and it's super cool to see it continue. But we got acquired about a year ago, actually, February last year. And since then I've been heads down on producing content, doing this. I literally every week I publish a YouTube video. I just got back from speaking at an event in Austin. I just decided, I've got 2 little boys. My wife and I were blessed. They're 11 months apart with these cool little dudes. And, I figured I'd take some time to just chill out, but still give back as much as I can. So Clarity was a really neat experience of building a platform to do that for other people. But now I'm really just focused on taking all my best practices from fundraising to building technology companies to just leading teams and putting that out there for the world. So I have a YouTube channel. It's grown to almost, I think we just cracked 4,000 subscribers in 6 months.
Oh, wow. Congrats.
Yeah, it's going fast. And yeah, every week I just keep publishing and people keep showing up. So.
Cool. And if anyone that's listening has any questions, you can enter them into chat and we can ask those live here to Dan. And I'm just going to start with some of my own questions. So the question I had first off, we have a lot of prospective angel investors here. You've made, I think it's 33 angel investments last I heard. When you started out, did you think you were going to be that prolific in how many angel investments you were making? Or how did that just evolve over time? How much of a strategy should people have when they get started?
You should have a strategy, and I'll teach you the one I would teach you today. Yeah. I did not. I started, what happened was the company I built, Spheric, was profitable. I was never one of those, the money guys. I drove I think it was an 87 Jetta for ever. Even though the company was making millions in revenue, I was never that guy. So I remember my accountant was like, what are you going to do with all this money? And I was just like, well, let's leave it there. Like, I don't want to, like, I remember my mentor said to me once, it's easy to make it. It's hard to keep it. And I was like, let's not waste it. But what happened is I'd meet these entrepreneurs, out and about, and just think like, man, I'd really love to be part of that company, but I'm obviously focused. And that's what happened. The first company I invested in was another service-based company that focused similarly in the technology I knew and I'd built a company around, but in a different platform. So I was like, wow, maybe if I give them money, get some equity in their business, kind of Shark Tank style, I guess. I took 40% of their company for 30 grand, which is just silly. Like I would never do that today. We can talk about that, but that was the beginning. And so my first 8 investments ended up being complete. Well, one of them did well, and that was the problem. Is my second one did 15x return in 5 years, which was a total, like.
And the problem was that made you want to keep doing it.
It made me think I was smart and that I actually knew what I was doing. And so it wasn't until I moved to San Francisco and I got connected with a guy named Naval Ravikant, who's the founder of AngelList. But back then he was writing at startupboy.com and venturehacks.com. Yeah. And he's the one that gave me the framework that I'd share with you guys if you're interested. But it was, I didn't think I'd be so prolific, but once I moved to San Francisco and I kept meeting with incredible entrepreneurs, I realized that, I wanted to be helpful. And there was a way for me to align their interests with mine more than just giving the money would be, to add that value. So my primary role is to help either with the marketing and the growth hacking and fundraising. So like anytime I put money in, my rule is like 18 months from now, we're going to raise another round for you, like your A round or your B. And then, that's where my responsibility, it's kind of like the next set of investors are accountable to get you to the next finish line. And that's been my role. So that's what I've done with companies like Udemy and Intercom and Get Around. And I mean, so many cool companies I've been fortunate enough to be involved with.
Well, it's interesting. So you work with companies that you can help on the marketing side. Is that something you'd recommend to other angel investors, to work with companies that they can really add value to? Or have you seen a lot of people be successful with more passive strategies as well?
I think it should be passive. The value add was the differentiator, because in the Valley, as you know, deals can the best deals are oversubscribed. So it's like they're looking at a list of 30 investors that want to invest, and they've got spot for 8, and they're deciding like, why should we take this guy over somebody else? I do not, and this is where I made the mistakes in the early days, is I invested in companies that I felt if they had my help or support, they would be successful. And that is not what you want to invest in. You want to invest in companies that
will be successful despite you.
You're just like lucky enough to like slide, like wire transfer sent, hopefully they don't send it back. Like, I can't believe I'm getting in kind of thing. Like that, those have easily been the best investments I've ever made. So yeah, value adds important as a differentiator, especially if it's a competitive environment, but you want to make it somewhat passive. And really just out of respect for the entrepreneurs. Like I don't ask them to send me updates. If they do, great. I think it's obviously a smart thing to do. I do it for my investors. But at the end of the day, it's their company. Nobody's going to understand the innards and the context as well as they. And if they reach out and need my help, that's when I usually kind of step forward. And personally, I always offer at least 1 to 2 hours a month where I'll meet with their team and help them get some strategic guidance if they want it. But that's kind of the upper limit as well, because if I'm doing more than that, then I'm really an advisor that should be compensated for that more, not just an investor kind of thing. So there's some guidelines there.
Well, I'm going to go back to asking what you would like to see or what you even send in your investor updates. But you mentioned the strategy that Naval gave you. Can you outline a little bit more about some of the key points about that for someone that's getting started?
Yeah, I mean, I've got, if you search YouTube, you'll have like my personal filters for how I invest. So just say Dan Martell Angel Investing and you'll find it. But Naval told me kind of 3 key things. One, always invest the same amount. So this is like number 1 mistake investors make, where they're
that was a mistake I made.
Yeah, so did I. I was like, oh, 30 grand, 50 grand, 100 grand. I'm just like, had no sense other than it just whatever they needed kind of thing. And he's like, make the same amount. And then the second rule is over a period of 4 years, and only if you can make a dozen investments. So he said the mistake people make is they might have 100 grand discretionary kind of put aside to do angel investments. And if they do 25K, then they can only do 4. And he's saying, no, do 10 and do 10 over a 4-year period. So he recommended at least 10. I think it's more like a dozen. And then the third part of that 4-year period is really to always be in the market. So don't try to time the market just because like right now people think we're at the top of a market, waiting till it comes down where the valuations are cheaper. It doesn't matter. Your goal, if you want to it's almost like dollar cost averaging and investing in the stock market, just always be putting money to work on a consistent basis. And it usually works out if you can get, if you can actually get good deals. And then there's a bunch of other stuff like don't be the only investor in the deal and all that kind of, fairly basic stuff that I definitely did not know or follow when I started.
So when an entrepreneur is coming to you, will you write a check in a first meeting? Or do you need to build more of a rapport with the entrepreneur? And if you are writing a check in the first meeting, what does an entrepreneur need to do to sort of blow you away in that meeting?
Yeah, I mean, so the answer is yes. The frame is what needs to be true for that to happen, right? It's less about what they can do. So what would need to be true would be, I got referred to them through somebody else I trust that invested. That would if it's a first meeting, so somebody that I trust their character and their investment abilities and that I know did the due diligence, made the intro. So that kind of takes care of a lot of that back stuff. Yeah. The next thing is I feel like, so what happens with me is I see opportunities for startups all the time. Like I have no, you're probably saying most entrepreneurs go through the world frustrated because they see friction and they can't believe that nobody's solved that problem yet. So what happens is if I meet an entrepreneur that finally comes to me with the solution to a problem that I personally have had, and I go, wow, yes, that's the right way. And you're the right team. The investor got introed. And to me, one of the big things is that I feel like they could teach me stuff like that. I mean, secretly, that's why I invest. It's as much as I want a financial return, but honestly, I'd be good, just getting my money back at some point, which is, if you do it right, it can actually be quite lucrative. But it's really, I invest in people that I feel are going to teach me things over the years, because that's the real passion for me is getting the inside knowledge and understanding of different markets. But those are the things that would have to be true. They'd have to come with a sense of confidence and domain expertise around the problem. A problem that I've personally have been waiting for. It's kind of like bringing water to somebody stuck in the desert. Like, yes, finally, this is going to get solved. And then I get that intro from somebody I absolutely trust. Those are the 3 times that's probably happened. Those were probably all true.
And all of the other investments were people that you had sort of been tracking over time?
Yeah. So either, we talked, I always tell people, I'm straightforward with them. I don't normally invest in a first meeting. So I'll just tell them right off the bat, especially if I'm busy and they're in a process. So if they're like, hey, we're raising, we've got a little bit of room left. And I know I'm heads down. Because again, I've invested while I've been building companies. That's always my number one thing is as an operator. I'm an entrepreneur first and an investor, almost to deal with my ADHD of opportunities I see. It's like my solution. But so if they're looking to close in the next 2 weeks and I don't even have time on my calendar to meet with them, I'll just be honest with them and say, it's probably not a good fit because of scheduling, or if I don't really feel like I'm going to be able to be helpful, which is one of my filters, then I'll just mention that. So if somebody comes to me with a biotech or whatever, I'm just it's not something that I know about. But other than that, it's a conversation, and then see how they kind of react to that feedback or the questions I have, and then kind of see how they follow up. Because to me, those little things matter so much. That tells me so much about how they're going to operate the business. If we have a meeting and then they never follow up, that says so much about their ability to recruit great people or close business development deals or whatever it is. So it's definitely kind of process, but it doesn't have to be that long. It can be 3 weeks, 6 weeks, and I can make a decision.
Yeah, and going back to the updates. So you said you don't require that your investments send you updates, but you send them yourself. And when you're sending updates to your investors, what do you think is really important to go in that, and how often do you send them? Yeah,
so again, video on YouTube, because I pretty much took every question people have asked me. I did 1,300 clarity calls, just so you know. So I have this almost 10,000 hours of entrepreneurial questions.
Frequently asked questions.
Yeah, the FAQs. But so there's a more in-depth answer there. But for me, it's more here's what people do wrong. So one is I usually send them in the early days every 2 months. I think once a month, it doesn't really matter. Like you're learning so much. So I think if you can at least do it once every 2 months, you're then in the 1% of entrepreneurs, because and it's funny because I did this video and people leave comments. They're like, I wonder how many of your portfolio entrepreneurs are going to then send an update.
Yeah.
Like, nobody did. Like, it's just so funny.
Really?
Yeah. There's ones that do it always and they have the discipline, and there's ones that I don't hear from until they're running out of money or they raise their next round, which, I get it, but personally every 2 months, the thing that I do that's different is I suggest they send the email to the individual investor directly. So they don't do a big BCC. They go Dan, comma. Now, I don't care if it's a copy and paste, but it should be direct. Now, the other reason why you should do that is because you should actually put the investors to work. So my rule is I have investors, they have to do work. They got to support me. So it might be an introduction to somebody, but I'll do the pre-work to make sure that it's relevant to them. So like, if I know that they have a relationship with another investor, I'll say, hey, could you make this intro? Or if I need an introduction to a specific company that I know they've sold a company to in the past, I'll be like, can you make an intro? So that's what's different about me. And then the third thing I would say is always start with the bad. Like, just rip the Band-Aid off. Y Combinator's got this new format for co-investors with them on a few deals. And it's pretty much the default dead. It's like a status. So we are, and then it's a link to the article that talks about it. But, I just got one today actually, and it was like, we are default dead. And then they go, as per Y Combinators, which means that their revenue and their cash burn is not going to eclipse fast enough. And that's, and now, could you close the deal tomorrow to change that? Could you reduce your head count and burn? Yeah, you could. So it's just kind of like, as it stands today, here's the trend. It's just good to know. So I always say, start with the bad right off the bat, end with the good, and put them to work.
Yep. And when you're talking to entrepreneurs that are setting out to raise their first money for a round, what are sort of most common mistakes that you think that they're going to make that you'll tell them to avoid right off the bat?
Yeah, this is my favorite conversation in the world. I love it. There's just something about fundraising. I guess, my background's technical, but I learned how to sell to enterprises. So business development, complex sales, that I just love this stuff. So fundraising is no different. It's a funnel, right? You've got to start. So number one, they don't. So I guess the biggest, it's funny because the things they do wrong are the things that I teach. I'll just teach the mistakes, which is, the opposite of what I tell them to do. One is they don't filter the investors. So meaning they don't actually pre-qualify the investors. So pre-qualifying investors is, have they written a check in the last 16 months? Do they invest in your space? And that, I would say those are like the first level filters that you should be able to decipher off of an angel list, or asking them, or whoever's referring you, asking them, who's the last company they invested in? Do you know if they've ever invested in companies in this space? Because many investors will take meetings, but I don't know, personally, I don't have a lot of time. And, if you just spend your time running around, especially if you're getting on a plane to go talk to investors, and the probability is 10%, you just shouldn't be taking those meetings, and the investors will always take it. Some investors take meetings because they don't want you to know they ran out of money, right? A lot of VCs, they have funds in cycles, and they actually don't have their next round, their fund closed, and it's been like 7 years, and they've run out of what's called dry powder, and they'll still take the meeting because they don't want to signal to the market that they don't have any money. And that's just a huge waste, right? And just a false pretense to the entrepreneur going, man, we had such a good meeting. Like, okay, that's a high possibility. It's like, no, it's like a 0, and they're considering it as a potential. So I would say that's step one. 2 is they don't go with enough investors. So it's a numbers game. It's a funnel, like most things in life. And you need, to me, when I sit down with an entrepreneur to help them raise money, it's 45 qualified investors. Like, make that list, filter them. You've got 45 names. Then you can geographically kind of group them if you have to get on a plane and go to New York or San Francisco or Toronto or whatever city, and try to get all those in-person meetings first. The other belief I have is that nobody's ever going to write you a check without meeting with you at least once face-to-face at some point in time. Meaning, if you met them at an event a year ago and you follow up to do a call about raising money, they would invest. But I've never seen a situation where a phone call, never met the person, has ever translated into a check. It's just, it's kind of like
except maybe AngelList.
AngelList is, to me, not the same thing, because it's all done through. So AngelList, but not the same deal. Like they're writing a check to the person doing the syndicate, right? For the most part, it's done through the syndicate. Yeah. They know that person. That's the check written, you know. So yeah, through AngelList, but AngelList is kind of a weird thing.
And have you ever used AngelList yourself, or any of the companies you've invested in used it? Do you recommend it as part of an early stage fundraise?
I feel bad because, I mean, maybe Naval would say the same. Well, he wouldn't because he'd want you to use it. I use it when my round's halfway finished anyways. So when I did it for clarity, and it was really like, everybody should have a profile. They should never mention their fundraising until like they're actually like, again, halfway done. So I used it as a way to broadcast to a lot of people in a very quick manner that I was actually going to raise for this startup. I mean, Clarity, my last company, it went from like starting it to 3 months later raising our round. So a lot of people didn't even know that I was working on a new idea. So doing that, and that's how I ended up raising from like Mark Cuban and a bunch of other great investors, because they were on AngelList and they got the notification. They seen who I had because I raised half the round already, I could confirm those investors. So they were following those investors. That kind of kicked it up to them. So yeah, there's a way to do it, but it's super strategic. I would never recommend that somebody just like create a profile and then start pinging investors and being like, invest in my deal. That there's usually some level of social groundwork engineering that needs to be done to get that, to make that happen. But I've probably done like 3 investments as a syndicate investor, but I still reached out to the entrepreneur prior to making the deal just to kind of get to know them better. But they were in a market that I was interested. For example, drones, this company called Nav Systems. Like I was interested in that market. I knew of them. And then when I saw them do the syndicate, then I was like a no-brainer. But I personally do it as like it's very personal, right? And angel investing to me is not I don't do it for the economic reasons. I do it because I like finding smart people and spending time with them.
Yeah. Well, you mentioned that fundraising is really a sales process for the entrepreneur, and they're trying to send out the right signals, and they're doing all of these things to really hone the image of themselves and their company. And, you know, you've been on both sides. How, as an investor, do you basically see through the bullshit? Like, how do you get to what's really happening?
Well, I guess it's kind of like playing poker. Maybe I don't play poker, but you know, like reading somebody. You know, it's funny because I teach this stuff, you know, to entrepreneurs I've invested in, and so when they do it to me, I kind of laugh. So they'll say stuff like, you know, we're oversubscribed, blah blah blah, and like sometimes as a joke, I might call them on it. I'd be like, cool, who's invested, you know, like who's leading, or like, and then then they won't respond. Like you can't bullshit. Like it's got to be true, right? So like when I went on, actually, like with Clarity, we were oversubscribed, and it was legit. And sometimes you can fake it by saying, look, we're only raising 500K, even though in your mind you want to raise like 1.2. Then you get to 5 and you say, oh crap, we're already the round's done, but we're thinking of So like there's smart ways to do that, and then there's really bad ways that if you get called out on it, you can't overplay your hand, because what I've learned, especially in this world with social media and Twitter and back channeling, like it just takes you to do that once, and then kind of everybody knows that you're not an ethical person, and nobody's going to want to be involved in a founder that does that. But yeah, so it's a lot of, it's due diligence. I mean, the other thing is kind of like engineering the traction curve. Like that's something that I've done. You can do it. Like just for example, if I had a launch list. So let's say you needed to grow 30% month over month compounded to build that hockey stick. All you do is you build a wait list on your website or like subscribe email list, and then you just strategically let people in the numbers that are going to convert to create that hockey stick, right? So it's not fake, it's not lying, but you can engineer it. So I might ask about that. I'll be like, so it sounds like you're in private beta. How have you kind of trickled people in? And then they'll be like, oh, well, we did it like this. Okay, well, that explains this. I just, so I guess the more you invest, the more you're going to learn, especially if you're an operator. And I mean, there's definitely an advantage to being an entrepreneur and being an investor, but you can figure it out even if you're not.
And how do you look at geography? I mean, I think that you have a really interesting perspective. You're on the East Coast here in Canada. We spent a ton of time in San Francisco. How does geography affect your investments? And also, how does it affect your fundraisers?
Yeah, that's interesting. The unfortunate, and I have a lot of local angels that look to me. I mean, it's, I had one company that pretty much said if I didn't invest, he wouldn't be able to raise his round locally because the other 3 investors knew that we were friends and was like, what's Dan saying? So it's tough in those situations because the truth is like, I want to invest in the best companies. And it's very rare that the best companies are not going to be in the major hotbeds. And the reason why is because a lot of them move there. And I'd say Canada's gotten really good with like Montreal, Toronto, and Waterloo and Vancouver. Like those are now locations where I've made investments because there are great companies. But Eastern Canada, I mean, I come from Moncton, New Brunswick. There's only one company I've invested in here, and there's probably, or no, 2 now. There's probably, been 100 over the last 5 years. There is a lot of activity, but there's not a lot that I would say, because my deal flow is San Francisco, New York, Toronto. So it's kind of like, the other 3 investors, they don't have deal flow that's more international. So of course, to them, that's the top of the filter, I guess. And I think for them, it makes sense. And if they do a bunch of those deals locally, then again, it follows the same principle. It doesn't matter where they're located. But personally, I do like those cities. And the reason why is because and most entrepreneurs don't get this. The reason why investors don't want to invest outside of their region is because they can't be helpful if you're outside that. So like if you're in Mexico and you're trying to raise from Toronto, well, those investors probably know 0 people in Toronto, from high-end developers to other investors to, senior executives. And that to me is the value add. It's like, I want to be able to meet somebody at an event and then recruit them to go work for one of my portfolio companies. That's not going to happen if it's not even the same geography. So that's the way I think about investing personally, and why investors choose to invest within a kind of a 2-hour radius of where they live.
And when VCs are investing, for a large fund, 150 million plus, they need to see potential that you're going to be over $1 billion company in order to write that check. As an angel, what is sort of the growth you're expecting from a company in order to think that it's worth your investment?
Yeah, so I mean, the truth is the early stage growth is really just a signal. So it's like probably one of 10 different factors that I'd look at, team and technology and domain experience being other factors. But when it comes to just a pure traction, I just want to know that they know how to build. So that's why, like, people that, I had a good friend of mine pitched me the other 2 weeks ago, and it was a deck, and he's like trying to raise $250,000 on a deck. And I'm just like, dude, it's too easy today to build a prototype and get early customers, that if you can't do that, then that's just a bad signal. I'm not investing, and I know my friends wouldn't even look at the deal. So just as an FYI. So can they build, and then can they get customers? Those are like the 2, like, to me, traction is, I know that you could build something the customer wanted, and then you sold it, and you've got some proof points, at least at an enterprise level, 10 customers, even if they're like pre-purchased, but they may not be all deployed yet, like just some proof that they've been able to get a customer and understand their needs and deliver on that. And then, then all things being equal, it's like, which one has the best growth curve? But in regards to how do they present the $1 billion company, to me, it's tell me a story. Tell me a story that over the next 7 years, you can build $100 million a year revenue company. That's all I'm looking for, which sounds crazy hard, and it is, but is not as hard as you think to tell the story. Like, if you're just like, look, 7 years is actually quite a bit of time. Here's what we're going to do year 1, 2, and 3. And then these things are going to happen. And, and the beauty of a story is nothing goes wrong. So it's like all these things just magically happen.
The world where this could happen.
Who cares if, like the world collapses, but if nothing happens in this, and I just think, again, to me, it's not even that it's going to be, that has the potential, is that the entrepreneur has the ability to communicate that. If they can't communicate that, then how are they going to recruit the best team? How are they going to raise their next round of funding? How are they going to convince a major partner, corporate account to trust them when they're an early day startup with like unproven code? That to me is what I'm looking for, is almost like, even if I know the story isn't going to work out the way it is, because it never does, I just want to see if they can do that. So that's the test.
Yeah. And for a lot of the people in the female funders world, we have some that are really experienced, but some that are really just starting out or coming from, you know, a totally different, maybe more corporate industry. You mentioned deal flow. How do you even begin to start building that if you're coming in as an outsider? And I think the same sort of applies to a new founder starting a company, not necessarily having any investors in their network. You know, what are events? What are strategies that you can use to start building that network?
Yeah, so on the investor side, number one is to find other investors. So that's and I mean, with AngelList, it's quite easy now today. I mean, back in the day when I started, like, it was really like behind the scenes asking other entrepreneurs that have raised money, who invested, and building that spreadsheet and reaching out. It was quite complicated. But on the investor side, I would just find other people that you know are doing angel investments. So you can go to the angel meetups, although I've never really done that route because I don't really believe a lot of those people are writing checks. They're just there for the social atmosphere. But yeah, that's a great place to start. You really don't want to be the only check in the business. So you want to find other investors, and you just say like, hey, if you ever do a deal, let me know. I'd love to look at it and maybe co-invest with you. Right. And like, I've had people come to me say, look, here's $100 grand, no matter what you do, the next 5 deals, I just want to invest, and I'll make it easy on you. I'll even put it into your, personal allocation, and, we'll make it like, those are really great ways to just start doing that. I mean, that's what I did in the Valley, Dave McClure, Jeff Clavier, those guys. It was like, hey, here's how I add value. If you ever have a company that you're raising for and you want that level of expertise, ping me. I'd love to look at the deal. And so that's what I would do on the investor, like wanting to become investor, like investing in other companies. As an entrepreneur, then what I would suggest is, so I teach entrepreneurs to build this thing called the Dream 100, which is 100 people that are going to support your business over the next 4 to 5 years. Those 100 people are 60% other peers, so people 1 to 2 years ahead of you. And then 30 advisors, so people that have expertise in different areas that you might have a gap in, like fundraising, like financials and legals. And then 10 mentors. The mentors are people that have been where you want to go and can actually, like, you reach out to them when you're trying to make a decision on turning left or right. Those 60 peers, I mean, if I was building a venture-backed tech startup, I would say 80% would have raised money. So what I've always done is made that list strategically, like Clarity is a marketplace. So my 60 peers were predominantly marketplace entrepreneurs that have raised money, so that not only could I ask them about who invested that know about their market, but also what are some of the unique dynamics of a marketplace, and just creating that group of people that you can spend a lot of time with that actually are on that shared journey, I think is just invaluable. So that's my strategy. It's what I teach people.
How did you create that group?
AngelList.
AngelList, and just
sending. In the past, there's a lot more work. In the past, I would have to use press releases, TechCrunch, Crunchbase, and then just searching the internet. And then, for like top marketplace founders, CEO of marketplace. So you'd have to do a lot more work. Now you can go New York City marketplaces, entrepreneurs, investors. It's crazy. Like, but you know what? Not people aren't going to do it, because like everybody's email is first name. What's that? What's
going in that email that gets them to respond and gets them to want to help you?
Yeah, so it's short, it's sweet, and it's a challenge. So most people don't realize that. So if you're an entrepreneur and you're trying to reach out to other entrepreneurs, you need to have something worth diving into. So if you reach out to me and say, I want to pick your brain and have coffee, or even buy me my coffee, I'm good. Not going to happen. If you say, hey, I just had my co-founder quit on me, and I'm deciding if I should keep going at it myself or consider this other person I know, you got 15 minutes. That's a phone call I'll take, because, we've all been in those spots and just having, so I always tell people, don't let a crisis be wasted. Like too many times entrepreneurs have a major challenge and then they just like go into a cocoon, binge watch House of Cards for 2 days. And I'm like, no, use that moment to reach out to your mentors, your advisors, and your peers, right? And if you don't have one, use it to get them, because there's meat on that problem that they can bite into and really be helpful. And if you're open and you're a great mentee, they'll usually say something like, hey, let me know if I can ever be helpful again in the future. And that's your open. That's the beginning of the relationship. But that, we all have those problems from, I just got a proposal for $100,000 to build my MVP, but I'm undecided if I should take that approach or hire my friend because he wants $50,000 a year. Like, that's a really good, oh, okay, well, which one should I do? Reaching out to somebody that's 1 or 2 years ahead of you, why wouldn't they respond to that? So that's kind of the way I think about it.
And what's your take on accelerators? You mentioned Dave McClure as being sort of a mentor of yours. As an investor, do you go to a lot of demo days? Do you see that as good deal flow?
I think
200 accelerators today.
Well, another one of my videos is how to create your own accelerator without going to accelerator. I've never been to them. I've been a mentor to several. I've been to several demo days. I think if you get the opportunity to get into Y Combinator or 500 startups, what happens now, and it's kind of neat, it's kind of like baseball where there's like farm leagues and then there's the MLB, Major League Baseball, is, the local accelerators are kind of like feeders to the big ones. So like, yep. I think last time I spoke at 500 startup, I asked like, how many of you have done another accelerator? And it's like 60% of the hands went up. And I was like, oh, okay. Like, so, do I think they're bad? No, I think they're good. I think that if you don't get in, doesn't mean that you're not going to be successful. That's why, to me, I like to teach people, like, here's how I don't want anybody else to be the gatekeeper. Like nobody, I grew up in a small town of 100,000 people and I made it work here. So there's nobody that's going to come to me and say, well, you don't understand. No, I understand more than you think I understand. And then really it's like, okay, well, what's the value add that they bring? They bring a cadence, right? Every week there's kind of an update meeting to kind of show people progress, a 3-month sprint, essentially a 90-day, like focus, heads down with a specific outcome and a goal at the end of it to raise money. So like all of these things can be manufactured within within a startup, even if you don't have an accelerator there, right? The Dream 100 list I talked to you about, that's essentially building your own kind of group of peers, mentors, advisors, so that you can get it done on your own. And a lot of these can be done through Skype video, Hangouts. I mean, you can build relationships with people through the internet. It's kind of a crazy world we live in. And you can be strategic about the events you go to, like Launch Conference once a year or South by Southwest. Like you might only have to do 1 or 2 events a year to really build up the base to support you. I think accelerators are incredible, but it's contextual in regards to where you're at in your business, if I think it's the right move, and who you are as a person and what the gap is in your abilities and skills, if I think that they're a right fit. And then also like YC is more product fundraising based and Dave is more distribution, marketing, and fundraising based. So like each one has kind of its own unique approach and maybe a specialty, like one could be more Bitcoin focused than another one be more drone hardware focused or 3D printing. I think that adds a lot of value too, to get just like quick domain expertise if you're new to the market.
Well, and I wanted to dig a little bit into actual terms. You probably see a lot of deals as an investor. What would you say are the typical valuations you're seeing, typical structure you're seeing for early stage investment right now?
So I'm seeing less convertible notes. So that used to be kind of a big deal in 2012 timeframe. It was like, uncapped notes, which is just silly. I've never done that and I won't do that. And I've never raised on that, even though I could have, because I just don't think it's aligning interest. It's super short-term greedy on the entrepreneur's point of view. But, convertible notes used to be more, but what happened is Y Combinator launched their seed docs, which is essentially, it's 10 grand legal fees to kind of do a priced round. And I feel like that's fair. It's like, look, it's early days. We don't have to do this. The convertible note argument used to be there when the cost of closing a kind of a formal round of funding was 25, 50K. And that makes sense. If you're only raising 250K, why would you spend a fifth of that funding in legal fees? But now where it's 10K, and truthfully down the road, it's just going to save you so many more headaches and what if in situations, if you do a down round or you have a co-founder leave or whatever it is, it just makes a lot more sense. So I'm seeing a lot more of that. I'm seeing a lot of bridge rounds, which kind of sucks, but that's just the case. Like a lot of entrepreneurs didn't raise enough money or didn't get to the level of traction. So now they're coming back to do essentially, what do they call it? A post-seed. I mean, they have so many really pretty cute names. Yeah. These like cute names for things, which means you essentially ran out of money and you need to raise another round to get your numbers working out. But term-wise, pretty clean and fair. Like, maybe on these bridge rounds, some investors are trying to take advantage of like liquidation prefs or whatever. But for the most part, it's been pretty clean. Now, I don't lead rounds, so I usually invest after somebody's already kind of negotiated with an entrepreneur. So I usually get deals that are fairly clean. So there could be a lot of craziness that I just don't see because of the, I don't lead rounds, so I'm not setting the terms, that kind of thing. But for the most part, it's been pretty good, and less notes and more kind of formalized seed rounds.
And you mentioned that as an investor, you'd never do an uncapped note, and as an entrepreneur, you'd never ask for it. Are there any other things that if an investor put it in a term sheet, you'd see as like a total red flag not to work with this person? Or same, you see an entrepreneur put something in a term sheet and you're like, okay, this is just not going to work. Yeah.
So I would say on the investor side, and again, I'm not a lawyer, so I have my lawyer and I send it to him and I just say like, you know my preference. Is there anything I should be concerned about? But things like a 3x liquidation pref or 2x liquidation pref, meaning that the investor is going to get 2 times or 3 times their money back before anybody else if there's a liquidity event. Pretty sure I've never signed one of those or had one of my entrepreneurs raised from an investor. It could happen though if you're doing a down round or you're in trouble, right? A lot of these later stage deals, like you're seeing Uber and other guys raise that level of money, there might be like little bonuses or kickbacks there because of the scale of those investments. So that, I mean, as an entrepreneur raising money, I wouldn't accept a term sheet like that, or obviously control anything more than that. If they're not going to lead the round and they want a board seat or even an observer, like I won't do that. If I'm raising corporate money from like a commercial entity, like a company that's got a venture round, I won't give them information rights because there could be a future point where they're a potential acquirer or a competitor. So those are things that I think about as an entrepreneur. As an investor, if they ask for uncapped notes, valuations that are just out of whack, if they're raising too much money.
What would be out of whack these days for,
like
let's say,
free or something? Yeah, out of whack to me today at a first money in, I would say would be anything above 10 million. Like that would be like, okay, you really need to bring the goods if you're going to ask for, 15 million pre or 20 million pre on a seed round. And I see them, but it's usually, really experienced founders, and it's a larger seed round, which is essentially just their way of getting to an A without having to do the seed and then A. They're just kind of putting it all into one. I don't like those either because I think that it creates a really bad set of habits for that founder that won't force them to make those tough decisions. It's kind of like a line of credit for a business owner. Like line of credits extend you making those tough decisions. And I think too big, too much money, too quick, same deal. Uncapped notes, too many investors. So, there's some, some of the guys in Toronto that raised with like 25 investors and they wanted me in. And I was like, I'm going to pass because it's just like, I don't get it. I don't understand the logic.
What are some of the pitfalls of that?
Nobody cares. That's the pitfall. Nobody cares. Yeah. I mean, the truth is most of the time, and this is true for Flowtown, less clarity, you're going to run into an issue and you're going to want somebody to lead the round to care so that if you need to raise another $250,000, you don't have to run out to the market and do a bridge round or a down round. You can just reach out to your lead investor that already put in $500,000 and say, look, let's do the deal. Like 2 years later, let's do the deal at the same numbers you originally invested in. And we'll do another quarter, 250,000 so that we can build out this new area. And like, that's the stuff that doesn't happen when you do these party rounds. So I don't do party rounds. I tell people not to do them. And that's just, so either too much money or too many investors.
Yeah. Well, I mean, that sort of brings me to the end of my questions here, but I want to sort of leave it to you. Are there any sort of final words of advice or things that you would say to either an investor starting out or an entrepreneur about to sort of hit the road on their fundraise? Hopefully not now because it's summer.
My personal belief, and it's just the way I've always built companies, is I like revenue. So, even if you have people are like, what about freemium businesses or social networks? Here's the deal. Social networks, run some ads and just see what the your CPMs are looking like for that user base, right? And that's the revenue per 1,000, people. Just even if it's like $8 a month, just know that like, oh shit, if it's $8 a month, we're trying to build 100 million a year business. That's a whole lot of traffic. So I'm a big fan of early monetization just to test. Or if you're doing freemium, start with the premium version. Like that's it bugs me so much that people are like, well, this is freemium, so we're going to launch this free product, and then we're eventually going to introduce a premium. It's like, okay, yeah, maybe. Very few companies, and companies like Evernote, who's the poster child, are running into issues today because it doesn't pan out like people think. So I'm a big fan of entrepreneurs monetizing early to give themselves the optionality if things go sideways, which they may. And that's not even sideways within their own business, but even within the market. Like, it may happen in the next 6 to 8 months where there's a correction. It's tougher. You're seeing, I think Drew from Dropbox recently posted, like, we're in this post-unicorn era where you're gonna have to be self-sustaining, and you're gonna have to be able to get to cash flow positive. So I'm a big fan of entrepreneurs moving towards that line, that kind of like, where's that line, and let's get towards it, so that when they go to raise, they have leverage. Because the best thing you can say to an investor is, I don't need to raise this money, but I think it would be a lot of fun to have you guys involved as a partner, and we think we could deploy this capital in a really efficient way because we've already proved that we've been able to do that so far. So that would be my, the Dan Martell guidance. That may not be, everybody else's thought and opinion, but that I feel like that's where we're at in the market. And I've always done, every company I've built, from Clarity to Flowtown to other ones I invested, they've monetized. There was a clear, like, business that was going to work out long term, and that, I think, is pretty awesome.
Well, this was a lot of fun, Dan. You're always like, I watch some of your videos, and this was like just amazing. You always have such great advice on both sides of the table, so I really appreciate it. And this is going to go up probably later today as a video, so I'll send it to you, Dan, so you can have it. I'll also send it to everyone that signed up for this broadcast. But I really appreciate your time, and hope you enjoy the rest of your beautiful summer day.
I do. I will. Catherine, thank you for doing what you're doing. I think obviously we need more women. I invest, I think 25 or 26% of my investments are women. And we need more on the investing side and founders. So I love what you're doing, and thanks for having me.
Well, thank you. I appreciate it, and have a great day.
All right. Talk soon. Cheers.
Bye.